Hello folks, Steve Lenz here with Discover Options here at Option View. Welcome to this presentation on three market timing reports for the S&P 500 for advanced options traders. These will be for Friday, August 17th, getting ready for Monday's open on the 20th. Presented materials for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So all three reports pertain to the current market condition. We have had two straight upswing days, Thursday and Friday, all above the 50-day simple moving average. In terms of the stochastic, we're kind of down in the middle area between 40 and 80. We are above the percent D. All of this makes for a market condition that's happened quite a bit more often than most market conditions, about 197 times since Jan of 2000. So it's not an unusual market condition to occur. So let's go take a look at the reports. The Condor Butterfly Timing Report. Since Jan of 2000, we've had almost pushing 4,700 daily closes of the S&P 500, 4,691. Of those, 65% have been favorable bars for selling options premium, where the actual 21 bar subsequent movement was less than what was being implied by the option prices as noted by the SIBO's skew adjusted VIX. Okay, so you could flip a coin roughly 2/3 of the time, you'll end up on a bar that is favorable for doing butters or condors. So that's the benchmark here. Also during that time, our current market condition, as I detailed previously, has occurred 197 times. Now, of those 197, 70% of the bars were similarly favorable for option premium selling. So now this implies an edge then of 5%. Okay, statistically then, it's more likely than usual that our current market condition will end up being a favorable one for market neutral option premium selling, okay? Okay, let's go to the bull put spread report. Now, this is interesting. The Condor Butterfly one showed a positive edge. This one shows a negative edge. Okay, so of the about 4,700 daily closes of the S&P 500 since Jan of 2000, 83.1 have been favorable for selling put premium. Now, when we define put premium, selling put premium, we're basically stating, looking at a notion of selling out of the money put premium, a standard deviation away, roughly 30 days out. Okay, so 83% of the time, all right, the market does not go down as far as what the option premium is implying. Okay, as it says here, I'm just going to read it. Of these 4,700, 83.1% have been favorable bars for selling put premium, where the actual 21 bar downside movement was less than the SIBO's skew adjusted implied movement to the downside. And we're noting that if it does hit that short strike, a standard deviation away, typically you would just take the loss and get out. Okay, that's kind of the premise here. Also during that time, the current condition, detailed like I described, 197 times. Of those 197, 81.7% of the bars have been similarly favorable for put option premium selling. Therefore, we have an edge of roughly a negative edge of just 1.4%. Basically, it's a scratch. Very, very close. Statistically, slightly more likely than usual that the current condition will end up being an unfavorable one for selling out of the money put premium. Well, if we have a negative edge on the bull put spreads, but a positive edge on the Condor, well, what's going on here? Okay, well, let's go and take a look at the market likelihood report, and this kind of paints a better picture here for us. So we begin by going to the very top of this, and we're taking a look at the rate of change. Okay, let's look at the rate of change. We're saying basically of the 4,695 closes of the S&P 500 since Jan of 2000, on average, the 5-day rate of change is at 0.1%. Okay, that's roughly 0.1% every 5 days. You can take a close and go 5 days later and look at the close. On average, it will have gone up 0.1%, a tenth of a percent. And that's because since Jan of 2000, we've had a bull market. There's been some bearish seasons, but the market's gone up since then. So that's the average 1 week change. What about the 2 week change, the 10-day change? 0.2, about a fifth of a percent. And the 3 week change, 0.30, not quite a third of a percent change to the upside. Okay, now let's go to our 197 occurrences. That's roughly 4.2% of the closes that we've had in the S&Ps. Okay, on average, this market condition has resulted, oh, and I didn't switch this out here. I'm sorry, I didn't switch that out, but we're looking at this one right now, okay? Yeah, I didn't switch these titles out. Cut and paste, it's the bane of our culture, I'll tell you what. So, on average, the 5-day rate of change of those 197, down 0.1%. Instead of going up 1.1, it goes down 0.1. So that's a change, that's a difference of a fifth of a percent to the downside. What's the significance of that? Well, if you take that difference and divide it by the standard deviation up here, you get a quarter of a standard deviation to the downside. So that's the significance of this. It's a quarter of a standard deviation to the downside. The 2 week change is 0.28, 28% of a standard deviation to the downside. And the 3 week rate of change is almost 40% of a standard deviation to the downside. So clearly, okay, the current market condition has a downward bias. A downward bias. It's not hugely dramatic. We're at about a quarter of a standard deviation on the Z-scores. Little higher than that going out to the 3 week. But that kind of accounts for why we have Condor looking much better than doing a bull put spread. Okay, that's where that accounts for. Now, what we've done is we divide these 197 into times where the market goes above Friday's close or Friday's high and below Friday's high. And that's what these are above Friday's high, and you can see if it goes above Friday's high, the Z-scores, well, on the short term 1 week, it's a 0.21, 21% of a standard deviation of the upside, and the other two are basically a scratch. Okay, now if it goes down below Friday's low, you're looking at Z-scores almost a full standard deviation to the downside, and then 61 and 75% of a standard deviation to the downside. So if it does go down below Friday's low, you know, look for some little bit more certainty of some bearish activity after that. Okay, in terms of volatility, the baseline market volatility is between 15 and 16%. That's just the on average the realized annualized volatility rate. Our current market condition results in realized volatility levels between 12.5% and 14% roughly, much lower than the benchmark. But that doesn't make any difference if you don't know what the implied volatility is. So let's go to the implieds. Currently, the VIX, the longer-term 30-day VIX is at 12.63, and the short-term 9-day VIX is 11.57. That structure is one that is a bullish one and is expecting lower volatility in the future. And what else? And the 30-day VIX is right in the ballpark of where we're at with the realized volatility up here. Okay, so kind of right. Well, the 9 days a little bit lower, but it's kind of right in the meat there. Okay, hope this has been helpful, folks. Thanks for joining me. I'm Steve Lenz with Discover Options. Have a great rest of the day. Bye-bye.